Hello and welcome. You're listening to the Investor Lab, the auditory epicenter for passionate people seeking a life of freedom, choice, and abundance. And if that is you, if you really, truly want to seek a life of freedom, choice, and abundance, then this podcast episode is exactly for you. On the show today, I was joined by Ryder, who is a long-term friend of the show. And he's been in the industry for 35, 40 years as a property commentator. He's got a huge amount of experience. He's seen all kinds of different cycles in Australian property and all of that kind of stuff. And what we talk about today is the truth of Australian property investing in 2022. We help to cut through the media noise. We discuss, things like, is the property market going to crash? What's the impact of interest rates? What about inflation? We talk about national debt, the impact of Ukraine. We talk heaps of different stuff. And we really cut through the noise to give you a fresh and insightful perspective on what is actually happening in the property market right now. So if you're interested in becoming a more intelligent investor and making better property decisions, then this is the episode for you. And of course, I believe that you're going to like this because I think it's a really great one and I really enjoyed it too. And if you do like it, I'd love for you to share it with a family member, friend, or loved one. Like, rate, and review us on whatever platform you are listening to. And without any further ado, let's get stuck right into it. And I'll see you on the inside. Hey guys, welcome back to the Investor Lab. Joining me on today's show is a favorite guest of the podcast, the venerable, the enigmatic, the iconoclastic oracle of property opportunity, Ryder. Terry, how are you?
I'm fine. Thank you for that wonderful, introduction. I do prefer oracle of information, but I'll let it pass.
Okay. Well, I thought about oracle of propertunity. I thought that might be interesting as well, but I thought, it might be getting a little spicy. How do you feel about being an iconoclast?
I don't even know what that is, so I'm not sure how I feel about that.
Well, that's good. That's good. I thought
it was some kind of microbotic type being, but
well, you can be a little robotic at times, fair enough. But no, an iconoclast is someone who challenges or attacks cherished beliefs or institutions, someone who challenges the status quo.
Well, that's exactly what I am. So, okay, well, I need to identify with this title. I'm very comfortable with that. I feel like I've been doing that most of my career, and that you sometimes wonder if anybody's listening, because it's an extraordinary thing, isn't it, that in life, despite everything, people still think that what they read in the newspaper is credible about anything, but say about real estate. There's nobody writing for our newspapers about real estate who's an expert, and most of the people they're quoting are non-experts as well. So people like you and I come along, and we are quite expert in this field, and what we say is credible and worth listening to. But most people would sooner believe what's in the Australian or the Sydney Morning Herald than what you and I say.
Yeah. I was just thinking as you say that, I think there's a reason for that, right? And I don't think it's a good one, but I think there is a reason for that. And that's because there's a lot of people out there who claim to be experts, and they've usually just got a vested interest. Now, transparently, I run a company that helps people to invest in property. So I guess I have a vested interest, right? And you run a company that shares information about the property markets. You kind of have a vested interest. But there's a lot of misinformation out there from people who say that they're experts, and then they're just essentially spruiking stuff as well. And so I think it's quite hard for people to try and decipher myth from fact. And so, then they turn to the media because they feel like it's independent, but of course, the media's got an agenda as well. And their agenda is to, sell more advertising space, basically.
Now,
so
there is no independent media anymore. They're all biased to a certain degree, and they're all pretty shabby at what they do to a large degree. But, people tend to attach credibility to people with big names and big titles. So people will believe the property price forecast of the chief economist for Commonwealth Bank, even though his track record is absolutely appalling. He gets it wrong spectacularly pretty much every time, but still people will quote that and say, well, property prices are going to fall because the Commonwealth Bank says they are. Well, look at their track record and determine whether you should give them any credibility or not.
Yeah, I tend to find that there's a common theme though with a lot of these commentators. The commentators tend to be more active when their prediction or forecast or whatever you want to call it is that things are going to go bad. And that could either be because they continuously think it's all going to go bad, or it could just be because news and media outlets only really seek out those quotes from those people when they're saying something that's, because like the whole newspaper adage, if it bleeds, it leads. There's a whole kind of psychology around what actually moves the news, and that's negative news, and gets people more engaged.
That's absolutely true. I'm doing a presentation tonight online, and I've prepared a slideshow. One of the slides is I've constructed as the misinformation cycle, and it, in simple terms, most of the people are part of that cycle have a vested interest in a sensational negative, and so that's what we're mostly fed about real estate, but about anything really. You're correct. When I worked in newspapers in the 1980s and the 1990s, and then the adage was it bleeds, it leads. Well, it still is. The fundamental tenet of journalism, whether they realise it or not. A sensational negative will work every time. But it's got worse. There used to be quality media and tabloid media, but now, in my opinion, it's all tabloid media. Yeah. And it's all about clickbait. And quite often, most of the time, the headline that induces you to click on the article is at best an exaggeration, but quite often now it's an absolute lie. The headline is an absolute fabrication just to get you to click. And when you click on the article, you find that the content of the article doesn't actually relate to the headline. You've just clicked on it all.
Yeah.
And it's kind of it's a form of fraud. If you and I tried to earn money in our businesses through fraudulent means, we'd be charged with serious offences, but media gets away with it every single day.
Yeah, it's interesting, isn't it? It's because, anyway, we could go on about the perils of media for some time, but it is central to what we're going to talk about today. It is central to what we're going to talk about. But if a lot of what the media is saying is farcical, right? What is the truth about the state of the property market in Australia in 2022? What do you think?
Well, I think the truth is that we have, as we normally do, different situations in different parts of Australia. We don't have an Australian property market. That's the first thing people need to understand. That's one of the first sources of misinformation in media. They talk about the Australian property market. Prices are going to rise X% or fall X%. Well, there is no Australian property market. People have to understand there are thousands of different markets. And so what's happening this year is that we have a high level of segmentation, which is the norm in Australia. We've got some markets that are rising very, very strongly, some that are rising moderately, some are kind of chugging along. There's a few they're actually showing signs of falling. Nothing unusual about that. So what that means is people have to understand that they need to be selective about what they buy, whereas last year it felt like you could buy anywhere and you were going to make money. I certainly agree that was true, but it won't be true this year because we have a different set of conditions, more normal conditions this year.
Yeah. So we did an analysis recently internally, and we looked at all of the statistically relevant suburbs in Australia. So we excluded about 2/3 of all of the suburbs in Australia because they were too small, not enough sales volume, whatever. And we looked at all of the statistically relevant suburbs. And in 2021, 89% of suburbs that were statistically significant grew, which was wild. That's the largest proportion of suburbs that have grown, I think, in the last 20 years or something. It's crazy. And I think now what's happening is we're kind of renormalising again, and that's okay, that's fine, but that doesn't mean that everything's going to go bad, right? It just means that we're actually renormalising to a state where, guess what? Some suburbs go up and some suburbs go down, and that is absolutely true in all markets. And what I think is really interesting on that, just to expand on that a little bit further, is kind of two parts to that. So first, people think that, the Sydney market, for example, grows or declines. They see things in the newspaper like Sydney property prices are going up or Sydney property prices are going down. But I can guarantee you that no matter what that headline is, even if most suburbs in Sydney are going up or most suburbs are going down, there's also a bunch that are doing exactly the opposite, and usually by some degree of extreme. Like you might actually find that if some suburbs are going up by 20%, there's others that are going down by 20%. It's not even just sort of vaguely different. It's usually radically different, but they still operate within the same generalized market. And that's an example of what you're saying. There's a highly segmented market where different suburbs move in different ways for different reasons.
Yeah.
And I think, just got one more point, and then I'm going to kind of give you some airspace. But the other thing I want to say about the Sydney and Melbourne market, and I think where a lot of people go wrong, and particularly where the media goes really wrong, is that, the overall market cap or the overall total dollar value of real estate in Sydney and Melbourne is significantly large, right? Because it's got a huge density of properties, and statistically, they're significantly more expensive than other parts of the country. So what tends to happen, I think, is when you then homogenize what's happening in the broader market, it's easy, if Sydney property prices go down, it's easy to kind of transfer that impact on other parts of the country, and I think it skews the data, basically, is what I'm saying, because there's parts of the country that are actually absolutely booming.
It does, and that factor is exacerbated by two things. One is that most of our major media emanates from Sydney and Melbourne. So what's happening there, they tend to extrapolate to all of Australia. And secondly, that they're much more attractive to a negative situation than a positive. So in the latest data from CoreLogic, for example, what it shows is fantastic growth still happening in most markets across Australia. The only markets that are showing any negative data, according to them, only according to them, because there are other sources with different information, which are generally ignored by media. The only one showing negative data is Sydney and Melbourne, and that's what media is focused on. And we're seeing headlines saying that property prices are falling across Australia, the boom is over. Based on 1 month's data from one source. And it's absolute nonsense.
Yeah, it's pretty interesting, though, because that is the narrative that people are believing. The narrative that people are believing is that property prices are going to crash, all of this kind of stuff. Now, I've been saying for at least, I'd say probably for 18 months, and I'm pretty sure you've probably been on the same general trend. Like when property prices in Sydney, for example, started booming, as they did in 2021, they started going through the roof. As that was happening, I was saying, this won't last. This is not going to last. This is not sustainable, and it is going to go down again. And as someone who lives in Sydney, I'm looking at it, and I'm thinking, okay, in a couple of years, it's probably going to be a good time to buy in Sydney, but not now. But it's pretty interesting that people do get fed that narrative that says the property market, in inverted commas, is going down, when that's just statistically and factually incorrect. Because as you said, a lot of areas are booming. A lot of areas started booming in 2020, right? And so then, yes, they were amongst the suburbs that were booming in 2021, but that doesn't mean that they only boomed because, there was some blip in the system. They're driven by fundamentals that are driving on long-term growth, jobs, lifestyle, and affordability, the holy trinity of location selection, essentially. But then you've also got some areas that started booming in 2021, and you've got some areas in 2022 which are literally just starting to pop out of their, hibernation and starting to grow rapidly right now. So how do you think people should be thinking about this if they're getting fed media every day that says the property market is crashing, and how can they start to get to some source of truth or some source of understanding of what's going on? Or any insights there?
Yeah, I've just constructed a slide for a presentation on that subject, 4-step process. Number 1, stop reading newspapers. Number 2, tune out all the media white noise, because it's not helpful. It's mostly misinformation. Number 3, do some actual research of your own and look at the real data. For example, most people would rather read what the newspaper says about the latest price data from CoreLogic rather than actually look at the CoreLogic actual price report. And you can see for yourself the reality of the numbers. And it's freely available. It doesn't cost any money. You just click and download it, and you look at the report and say, hang on a minute, Brisbane and Adelaide and many of the regional markets, they're rising at a rate of more than 2% a month. That's, annualized, that's over 25% a year. There's still incredible growth happening in Australia. You can actually freely access that information and look at it rather than absorb the media sound bites, which will always accentuate the negative. And the number 4 in the step process, don't be a herd animal, because most property investors are. They follow the herd. Smart people were buying 18 months ago, but most people still, I read that prices are going to fall because of COVID, so I'm going to wait. And those that waited wish the hell they didn't. And then when they read there was a boom on, they wanted to pile into the market. And of course, they missed the best time to buy in the best places. So the average punter goes about it totally the wrong way. They absorb media sound bites and believe what they read. They are impacted by all of that, and it affects their decision-making. They don't do any real research, and they just follow the herd. Those who detach from all of that and go about it sensibly and independently do well in real estate, but they're relatively few in number.
So they need to be a bit more iconoclastic then, Terry.
Iconoclastic, yes, but you will need to provide a definition when you use that term with most people.
Yeah, there's a quote by Mark Twain which I love, and it's something I might butcher it a little bit, but it always stands out for me. And it's something like, when you find yourself standing on the side of the majority, it's time to pause and reflect. And I think that people need to kind of take that on board a little bit more. So let's dig into this a little bit further, because so firstly, do you think that property prices in Sydney and Melbourne are going to continue to decline?
Well, no, I don't.
Interesting.
Well, you see, the analysis, if you can call it that, we're getting in media is usually from economists, and they think that the only factor in play here is the level of interest rates. They think the only thing that caused the boom was low interest rates, which is kindergarten analysis, and they think that because interest rates may soon rise, that property prices are going to fall everywhere, and it's just bunkering.
No, let's dig into that, because there's a pretty logical thesis for that, right? Particularly in places like Sydney, right, where the median property price is really high, right? And so home ownership affordability has been really good. So people have been able to extend themselves a little bit further to buy as owner occupiers, buy properties, live in them as homes, right? And as interest rates rise, the cost of home ownership is going to rise, and some people might find themselves stretched beyond their means, and that might actually cause less demand in the market. So, particularly, I'm specifically talking about high value markets like Sydney. So, do you not think that would be true?
No, I don't. That's the general media theme. Interest rates will rise. There'll be mortgage stress everywhere. Prices will fall. And no. Lots of reasons why that's not right. Now, we can look at what's happened in history with interest rate rises and the impact on a boom, which is negligible. But it's the buffering in the system that's being overlooked rather conveniently by media, because they love that storyline. So there's three big buffers in the system, which will mean that one or two interest rate rises isn't going to have a major impact on the average household. One is that the level of savings that are being built up in the community because of the enforced savings, because of lockdown periods, etc., the restrictions of COVID. The second buffering is that the average household is more than 2 years ahead on their mortgage payments. And the third one, the biggest one, is that no one is assessed on the ability to repay a loan at the current interest rate. They're assessed on the ability to repay that loan, the current interest rate plus 3%. So if you're borrowing now, you're not assessed on whether you can afford to repay that loan at 2.5%. You're assessed on your ability to repay at 5.5%. So interest rates could rise 2 percentage points. And the Reserve Bank put out some modelling recently that media seized upon, saying if interest rates rise by 2 percentage points, then we think there's a possibility that property prices could fall 15%. And media lap that up like a hungry dog. But most people actually can afford to repay their loans based on the buffering in the system dictated by APRA if interest rates are that high. So
it's a very good point, Terry. That's a very good point about the buffer. There's actually, no one actually is borrowing at their actual limit. That's a very good point, actually.
Yeah. So, media love to rabbit on about mortgage stress, and there's no official definition of it. So anyone who wants to generate a negative headline, all they need to do is say, look, we define mortgage stress as anyone who's paying more than 25% of their household income on their household costs.
Yeah.
Well, who the hell says that puts people in distress? I don't think it does. But, somebody just decides arbitrarily to suit their purpose, which is to achieve publicity, to declare that that's mortgage stress. And therefore, 40% of households in Australia are in mortgage stress. And media will lap that up. They'll never question it. They'll never ask any hard questions of the source of that data. And so the cycle continues. But to answer your original question, which is about Sydney and Melbourne, there are a lot of things in the system that aren't being factored in, because the people making the commentary and writing the articles think that it's all about the level of interest rates. What about other big factors? And the biggest of all is the reopening of international borders. The fact that we now have large numbers already of overseas migrants and international students coming back into primarily Sydney and Melbourne. What's the impact of that? We've already seen the vacancy rates for Sydney and Melbourne, particularly the inner city, coming down dramatically. And now we're starting to see rents in the inner city rising again. So there's this whole new wave of demand in the market that nobody that's being quoted in the media has actually factored in, because they think it's all about the level of interest rates.
Yeah, that's pretty interesting. Yeah. So, and just to expand on one of the points you made about the kind of like the war chest that's been saved up over COVID. So, last I read, the combined savings in business and personal savings, right? And the business piece is interesting because when businesses have got surplus cash, they do that. They grow. It supports jobs and all of that kind of stuff. It's a combined total of $430 billion of just cash sitting there waiting to be deployed on economic, opportunities, whether it be buying real estate, growing businesses, creating more opportunities, all of that kind of stuff, which is pretty interesting. And yeah, I tend to agree with you that I think that there's a lot more opportunity in the system than most people are talking about. But do you think, let me ask a slightly different way, and I'm curious, what area do you think that, all things being equal, over the next, let's say, 12, 24 months, and not too attached to a specific timeline, but just generally speaking, over the next little bit, do you think that regional areas are going to outperform capitals, or do you think that capitals are going to swing back, or what do you think's going on there?
I think, look, I just want to say one more thing about Sydney and Melbourne and then go to that question. The media is saying that prices are falling in Sydney and Melbourne, and that's 1 month's data from CoreLogic. Other research sources say different things, whereas CoreLogic says in the month of March, there was a slight reduction in median price for Sydney and Melbourne. SQM Research actually records a rise in March for both Sydney and Melbourne. So
that's interesting.
Whose data are we going to believe? Look, I've been highlighting this for years. I've quite often in some of my reports highlighted, here's median price situation in all the capital cities from 4 different sources. There's Domain, there's SQM, there's CoreLogic, the Bureau of Statistics. They've all got different results. I just Googled as an exercise, what's the median house price for Blacktown, suburb of Sydney?
Yep.
I got an answer from 6 different online sources, including CoreLogic, Domain, and others.
Yep. And
the range of answers ranges from 745,000 to 910,000. So what is the median price for Blacktown? Who knows? It's anywhere between 750,000 and 900,000, according to these different sources. Who do you believe? Now, if you Google any suburb in Australia, you're going to get the same level of disparity. And media tends to regard, data from CoreLogic as absolutely gospel truth and sacrosanct. It's not. It's all dodgy data. And, you've got one source saying Sydney prices and Melbourne prices are falling, and others saying, no, they're not, they're rising. Who do you believe? Well, probably neither of them, because, what they're attempting to do is ludicrous. They're attempting to put all the tens of thousands of transactions in a city as big as Sydney with over 700 suburbs and as disparate and different as Campbelltown versus the Northern Beaches or Penrith versus Bondi, and distill all that into a single figure to describe Sydney property market, and it's ludicrous.
Yeah.
Now, you asked about regional markets have been outperforming their capital cities for quite a long time, for at least 5 years. And the latest data from CoreLogic, if we can believe it, and I'm going to make one more comment about that so people can really understand why it's dodgy data. The latest figures from CoreLogic suggest that regional markets are still very much outperforming the capital cities overall, but you've got to look at it in individuals because Brisbane is still pumping strongly despite everything that's happened with the floods. Adelaide's pumping unbelievably, but many of the regional markets are doing very well as well. But I just want to make this other comment, and I would like people to think about this. On the first of every month, CoreLogic publishes its price report saying what happened to prices in the previous month. So on the 1st of April, it published its report on prices in March. And what they published on the 1st of April was a 6-page analysis full of graphs and charts and commentary and what it all means.
Nice.
They would have been writing that report in the middle of March to get it ready, to get everything ready to publish on the 1st of April. So how can they tell us what's happening in property prices in March when they're writing a report long before March has even ended? But even taking that out of the equation, all the sales aren't through the system at the end of March. There's a lot of sales that haven't yet settled. So they do not have complete data for March to say what's happening in March. They're perpetrating a deception on the people of Australia. The media laps it up, they don't care, but no one's ever asked that question. How come they can produce this incredibly detailed report the day after the month ends, which purports to say definitively, without anybody questioning it, what happened to prices in March.
Yeah, there's another interesting piece in that too, right? Because they can't report the price until the property has settled, right? They get that information from the Valuer General's office on settlement. But the price that is paid or agreed happens long before the settlement date, right? So typically, but when you get the property under contract, then you'll have, let's say, 21 days of conditional, building and pest and finance and all of that kind of stuff, and then 30 days of settlement. So you've got 51 days between when the price exchange happened or the price discovery moment happened, and then when the reporting moment happens. A lot can happen in that period of time. Like a lot can change in 51 days in a fast-moving market, right? So that's pretty interesting, actually, too.
So the central message here is, all real estate data is dodgy data. It's all rubbery figures. You cannot take it to the bank. I think people overestimate its importance. And the other really important thing is here, even if it was accurate, it doesn't actually tell you anything useful about where you should buy it. It doesn't tell you where it's going. Yeah. It doesn't inform the future. And the things that people should be interested in are things other than what's happened with prices historically, what's happened in the last month, last quarter, the last year. It's irrelevant to where you should be thinking of buying. Back
to my question then, Terry, right? Because I've got a viewpoint, right? And I'm interested in your viewpoint. Where do you think, do you think that people should be thinking about regional areas? Or do you think they should be thinking about, and look, I get your point about capital city areas because they're not all the same, right? Perth, Adelaide, Brisbane, Hobart, they're all different, right? So, but broadly speaking, I kind of tend to basically almost think like there's Sydney and Melbourne, and then the rest of Australia is probably a better way of thinking about it. So
it's usually the exception to the rule, actually, Sydney and Melbourne.
Yeah, so it's kind of like so I'm just kind of thinking about that now. So, okay, so Sydney and Melbourne versus the rest of Australia, and the rest of Australia includes the rest of the capital cities and all regional centres and all of that other kind of stuff. Where would you be putting your money in 2022?
Well, it comes down to individual locations. There are some capital cities, particularly the smaller ones, that are absolutely pumping and have good prospects for future growth, particularly Brisbane and Adelaide, but Perth also has good potential. And then there's a whole range of possibilities in regional areas, regional Queensland, regional New South Wales in particular, but also, right across regional Australia, there are good possibilities. Regional Western Australia.
Regional South Australia.
Regional South Australia. We've done recently a couple of reports, one 6 months ago and one that's just about to be published now with CanStar, the comparison site. And we've been ranking markets on certain criteria, and regional Western Australia ranks very highly in both those reports. Regional South Australia ranks very highly, the most recent one, which is about first home buyers, therefore affordability. Regional Queensland and regional New South Wales actually are 1 and 2 on the report we did 6 months ago, into where we ranked markets on their prospects for future growth based on a whole series of different metrics. So, and we're seeing that in the numbers, and also just looking at it kind of more anecdotally, there are some wonderful regional centres in both New South Wales and Queensland, which are relatively early in the cycle. They've got great prospects for growth because of what's happening in their local economies. They offer affordability and good rental yields and low vacancies and all of that. So that would be a good place to focus. The other thing that's worth saying is that there's no one right answer to that question. It depends on the individual. And it's a point I make continually because I keep getting asked, where's the best place to buy? Well, it depends on you. You could have 6 people in the room and there'll be 6 different answers depending on the circumstances of those
100%.
How much they earn, how old they are, what's their risk profile, and what they already own would dictate where's the best place for them to buy right now.
Yeah, I couldn't agree more. I absolutely couldn't agree more, because there's definitely some locations that are more suited for different types of strategies and, emotional profiles, all of that kind of stuff. Okay, so where I'm trying to get to, right, is I really don't care, right, about which one. I'm completely market agnostic, right? I think there's no such thing as a bad asset. There's only bad asset selection. And that kind of goes back to your point about what is the right location or what is the right property for me might not be the right location or right property for you, right? So for some people, buying in places like Sydney and Melbourne right now could be great. And for other people, it might not be. But I tend to think, though, broadly speaking, that there is so much value being pushed into the areas outside of Sydney and Melbourne that I think that that's really hard to ignore. I think that, look, you can never believe what a politician says, but the politicians are there's an election coming up and there's a lot of people talking about all the jobs and stuff that are being pushed into the regional areas. Not only that, you do have the affordability piece. You touched on that CanStar report you just talked about, and affordability is real. Like if people can buy, if someone has a choice between buying a $1 million house in Sydney versus a $500,000 house in, regional New South Wales, and to get the same quality of property, same size of property, same or whatever, right? Then that's a real thing, because I can save $500 grand and use that money to live a better life and do all of that kind of stuff. And there's, when we cook it down to jobs, lifestyle, and affordability, it seems like most of the opportunity is going to exist outside of the denser centres, because that's where most of the projects are being pushed to. The reason for that is there's actually room. There's room and resources to actually do bigger projects. That then drives job opportunities, and which, as we have migration coming into the country, they will be economically driven to seek out the opportunities that exist in those regional. I say regional loosely because I don't mean far-flung country towns. I mean like rest of the country that's not Sydney, Melbourne. The people are going to seek out those opportunities, and then as people get to have a better lifestyle because it's more affordable, there's more room, there's all that kind of stuff. So I tend to think that right now it's like, I think there's going to be a cyclical shift that's going to make Sydney and Melbourne much more exciting over the next, 4 or 5 years. But right now, I think that the main thrust of the opportunity exists outside of those areas.
Absolutely, it does. And there's some really good, solid reasons for supporting that argument, other than the fact that are more affordable and you get better rental returns. Number one is the dominant trend at the moment, and has been for some years, is the exodus to affordable lifestyle, as I like to call it. And contrary to what, again, media misinformation, they tell people that this has been caused by the pandemic. So when the pandemic's dealt with, people will move back. It wasn't caused by the pandemic. It's been going on for many years. Sydney's been losing population to internal migration for more than 10 years, and Melbourne in big numbers for the last 5. So even before we'd even heard of COVID, it was happening, and it's still happening, and it will continue to happen, because it's about the pursuit of an affordable lifestyle enabled by technology, which means people can effectively work remotely, and more people are making that choice. The second thing is the big infrastructure spend. That's hugely influential and impactful, and a lot of it is being directed to the regions. I mean, we have a top 10 report, the infrastructure-led economic recovery, national top 10 places most likely to benefit from that. And there are more locations in the regions in our top 10 than there are in the capital cities. And the third thing is local events, which can have a big, big influence. And I was doing an interview live on ABC Radio yesterday talking about specifically regional Victoria. And they were worried about what the Reserve Bank said, the property prices are going to fall 15%. And I said, so a value is going to fall across regional Victoria by 15%. I said, no, nothing like that's going to happen. They're talking generally, they've got a prediction model, which I think is flawed anyway, but there are local reasons why regional Victoria is not going to do that. And one of the ones was they were actually talking about in the segment before I came live on air, and that was the fact that it's highly likely that in 4 years' time, regional Victoria is going to host the Commonwealth Games in places like Bendigo and Ballarat and Geelong and other places. Now, what is that going to do for property markets over the next 4 or 5 years in regional Victoria? Because they're going to have to spend massively on infrastructure. They're going to have to upgrade all their sports facilities. They're going to have to improve their transport infrastructure. The tourism industry is going to have to invest in infrastructure, because there's not going to be enough hotel rooms in those places to cater for all the spectators, et cetera, and the competitors. So that's a massive local event that's going to mean that regional Victoria is certainly going to be an exception to that generalised statement. And then you've got in regional Queensland the impact of the impending 2032 Olympics, which isn't just in Brisbane, it's also Toowoomba, it's also the Sunshine Coast, it's also the Gold Coast, it's also Townsville. I mean, these local factors are the most dominant of all. So you've got all those things in the mix, which means that so many parts of regional Australia are going to be compelling places for people to buy, where you can buy affordably, good rental yields, vacancies are hideously low, which is great for landlords, not so great for tenants. So, wonderful prospects to be found.
Yeah, I think there's an interesting thing there that people kind of miss. You've said the words good rental yields a couple of times. I think people miss the importance of that. they misunderstand how important that is to building a prolific, profitable property portfolio, because anyone can go buy a house, right? But the difference between buying one property, which is where 71% of property investors get to, buying two properties where 90% of property investors get to, and buying 5 properties where only 1% of property investors get to, is the ability to be able to continue to borrow, to have that liquidity in your portfolio to be able to continue to borrow, right? And so I think that's a huge piece that people are missing. And when they're thinking about risk, they're not thinking about the risk of actually never achieving their goals because they can't actually build a portfolio that's going to be able to sustain what they actually want long term, which is really interesting.
It's a really important point, because your ability to keep going back to the bank and asking for a loan to buy the next property depends to a very large degree on whether the properties you already own are paying their own way. So if you've got 2 investors, they each own 5 properties. One of them has 5 properties which are all negatively geared, so it's taking money out of their pocket for every single one of them every month. And the other one's got 5 positive cash flow properties. The one with the 5 positive cash flow properties is more likely to get a loan to buy a 6th property than the one who's got 5 negatively geared properties. And that's a really important point in developing a portfolio. It's important that the early purchasers have the ability to sustain themselves without dipping into the income, the personal income of the borrower, because it affects your ability to get finance to buy the next one and the next one.
Exactly.
And so buying in location with high rental yields is really important.
Yeah, of course. Now, just like on balance, you don't want to just chase rental yields, just in the same way you don't want to just chase growth. Like I think having that right combination that is going to allow you to, build your wealth and allow you to be able to continue to buy properties so that you can build a portfolio that's going to be able to sustain the life you want. Like that's the goal, right? So, and I think that's where a lot of people go.
And if you choose the right locations, you can have both. Exactly. I keep getting asked the question from people, should I go for high yield or should I go for capital growth? And I said, well, you should go for both. You go for both, because people think it's either one or the other, and it's not.
Yeah.
If you bought in, say, I don't know, Ballarat 3 years ago, you will have achieved fantastic capital growth, but you also would have bought probably at a rental yield above 5%. And 3 years later, because there's such a shortage of properties there and low vacancies, the rents will have increased magnificently. Yeah. So you will have a really high rental return. And that's happening across the country with people who are buying well in regional areas and also in the smaller capital cities.
Yeah, there's another interesting phenomenon that's going on at the moment, which we've picked up on, is that rents are moving so fast, right? So typically we try and target what are typically higher yields, right? When you've got the national average yield of being like, 3.5% or whatever, we're typically targeting 5.5%, 6%, sort of 7%, even higher. But what's been happening recently is we've noticed that we can get a property under contract to like 5% yield. And by the time it settles, not even like a year later, by the time it settles and you actually go to put a tenant in the property, it's suddenly a 6.5%, 7% yield. I can talk from personal experience. We bought a property in WA recently, and I think it was 5.2% yield was the rental appraisal when we bought the property, and it just settled, and now it's going to rent out for 7% yield, 7% yield, because rental prices are moving so fast. And I think that that's what some people are not understanding, is that we actually have, and this is not to, like, I don't want to sound like this can come across wrong. We have a rental and housing crisis in Australia, which is not good, right? Because that means that people can't afford, there's not enough houses for all the people who want them to either buy them or live in them, which is, socially bad, right? But it doesn't change the economics of how that fits with property. And at the moment, we're not able to build properties fast enough. So I can't even remember what the shortfall is, like 150,000 shortfall or something.
And it's taking twice as long to build properties at the moment because of the shortages of everything. Yeah, so it's a real issue, and it's going to get worse before it gets better in terms of the rental shortage, because neither of the major policies give any indication they're even aware that it exists. They don't have any policies to deal with it. They're all talking about housing affordability, although none of their policies actually address affordability. But none of them, in the recent federal budget and the federal opposition's reply and the policies that we're seeing rolled out in the election campaign, none of them have any policies to address the rental shortage crisis. And the Greens, if they ever get the balance of power, have got policies which will make it immeasurably worse. So it's a great time to be a landlord, and it's going to continue to be, because we have a shortage. Like, I've been doing this for 40 years. I've never seen vacancy so low, and I've never seen rental growth figures as high as we're currently seeing. That's because they've never been as dramatic as they are right now. So, I'm experiencing with my own personal investing, but many of the clients that I talk to are having the same thing. I bought a property in a capital city, Adelaide, 18 months ago. The rent has gone up. It was 310,000. The rent initially was 340,000, which was already a
$340. If it was 340 grand, mate, you'd be laughing.
$340 a week on a property that cost 310 grand to buy,
which is good.
But the rent is now 440, 18 months later. So the rental return is, I don't know, it's over 7%.
Yeah, that's crazy.
Not bad for a capital city. And the value of the property, according to the bank, with a recent refinancing, is now 450,000, where I paid 18 months ago 310.
Yeah.
So great capital growth, incredible increase in rentals, wonderful rental yield for anywhere, but particularly a capital city. But that's a 7.3%
yield. So I just worked it out.
Yeah. And if you told somebody that you could buy in a capital city and get that kind of a rental yield, they'll think it's not achievable, because, in Sydney and Melbourne, 2 or 3% might be the best you can do. But in some of these smaller capital cities and regional areas, you can achieve those sort of outcomes by buying in the right places and buying the right sort of property. And it's still achievable. And the people who succeed will be the ones who tune out all the white noise from the media and just get on with it and buy well in those sorts of areas. And they will, through that mechanism, 5 or 10 years from now, have a very good property portfolio.
Totally. I think one of the things that kind of unsettles people, though, is we're in a much more kind of globalized world. There's things going on in Ukraine and, China and the US. And I think people get kind of like caught up in that because it makes them feel uncertain, and particularly with the media's propensity to superimpose things that are happening globally on things that might be happening locally. I think that can really, really skew people's perspective, because I read, I do try and stay up to date with things that are going on in the world. And there's talk about like the US debt crisis, and Ray Dalio released a book about the changing world order and all of this kind of stuff. And people think, oh my God, that must mean all of that stuff's happening here in Australia as well. And I think they forget about like the tremendous levels of prosperity that exist in this country. And I just want to point out an interesting fact, and I'd love to kind of get your take on this kind of like global versus local psychological lens. But in the US, there's a lot of talk about, the interest rates are rising in the US, and there's, what about the national debt and all of this kind of stuff? And people are genuinely concerned it could be an issue. And in the US, the government debt to GDP ratio is 138.1%, right? Which means that they have 138.1%. The total amount of debt is 138.1% of the total amount of gross productive output of the whole country. Okay, so not great, but also there's countries that are at like 250%, right? Japan's at the top of the list. It's crazy, right? In Australia, our gross debt is at 45.1% of the GDP. Our gross debt is at 45.1% of GDP, and it's forecast to get up to a max of 50% debt to GDP, right? Which, I don't know, if you were thinking about that like a property and you had a 50% LVR on the property, would you be that concerned that you were like overextending yourself or anything like that? And I think that these not really, it's back to the kind of points early on, like looking at these headlines and actually not actually doing the digging yourself to actually understand the numbers can give people a really skewed perspective. What do you think?
Oh, absolutely. People worry about all sorts of extraneous matter that are completely irrelevant. You mentioned Ukraine. There was a headline only a matter of a few weeks ago which said property prices tipped to fall 15% because of the war in Ukraine. And I thought, what possible impact on Australian property prices could the war in Ukraine have, to the extent that property prices will fall at the level that we've never seen before? And of course, it was absolute rubbish. And it came from one of the greatest sources of real estate misinformation, who is Shane Oliver, chief economist for A&P Capital, who's got the most spectacular track record of getting forecasts about property prices wrong. He's just spectacular, and his consistency, because he just doesn't get it. So he was putting forward the proposition that because of the war in Ukraine, our prices are going to fall 15%. And I thought, my God, it just gets sillier and sillier. If anything, the war in Ukraine will be more likely to actually Australian property prices more solid, because what we have learned from recent times is that in times of uncertainty, people, it's a cliche, but it's true, people retreat to the solidity and safety of bricks and mortar. We saw that in the wake of the COVID crisis. It's one of the big factors why we've had this property boom. Everything was uncertain. The share market was crashing. People were worried. They retreated to what they knew was tried and proven and safe and solid. And we saw it post the GFC. In the years after the GFC, property prices were predicted to fall 40%, but they actually rose in 2 years following the GFC. Same syndrome. And it's hard to put into an economic formula, but it's true.
Well, it's not that hard to put into an economic formula. Like, it's really not that hard. Like, all you need to do is follow a logic chain. Okay, so let's follow a logic chain there. So let's say there's a war in Ukraine, okay, which is bad. I got friends who've got family over there. It's not good, right? What tends to happen when there's times of war is supply chains get disrupted, and we've seen that playing out. Commodities have been disrupted and all of that kind of stuff. So, okay, what happens when supply chains get disrupted? It means the cost of goods goes up. So oil, food, raw materials, that goes up, okay, because it's harder to get, there's disruption. Okay, that makes sense. So what happens when commodity prices or the cost of goods and stuff starts going up? That's inflation. Okay, well, what happens in an inflationary environment? Well, cash devalues faster. The dollars you've got in your hand don't work as well at the shops, cost you more to buy a loaf of bread, etc., right? So in an environment where cash is at risk of becoming less valuable, what are the best inflation hedges? Like, where do people try and put their money? How do they get certainty? To your point, right? When they feel uncertain, they want to get their money in a place where they feel like they're not going to suddenly see it all disappear, right? And that tends to be really two places: precious metals, gold and stuff like that, and real estate, right? And so I like, when you talk about it, when we hear all this kind of stuff in the media, oh my God, it's all going to go bad. It's all going to. I just question. I'm like, what is the logic pathway that you have used to arrive at the deduction that property prices are going to fall? Because it just doesn't make sense. Like, I can't quite work it out. So,
yeah, I mean, look, the people who succeed are the people able to, as I say, just tune out all the white noise in the background because it's irrelevant, and just think clearly and logically and act independently. I mean, 18 months ago when COVID had struck for the first time, and media was predicting disastrous consequences for Australian property prices, that's when I went out and bought 3 pieces of real estate in different parts of Australia. And now we're again amidst a wave of doom and gloom in media. The boom's over, prices are going to fall. I'm gearing up to buy another couple of properties because, buy when others are selling, sell when others are buying. When everyone's panicking, that's when you keep a cool head and think and act independently. That's when the opportunities exist. You're detached from the herd. Most people follow the herd, and that means they buy at the wrong times and often in the wrong places.
So, do you ever think, because you're very pro property, right? Do you ever think there could be a situation where the property market crashes, right? Because that does happen in places like, obviously saw it in the US back in 2008, but that was obviously not about property. That was actually about the debt instruments that have been stuffed up by all the quants. But do you ever think we could get in a situation where the property market does crash?
In Australia, I can't see the circumstances where it could crash. It depends how you define crash, of course. But you referred to that situation in the United States where post-GFC there was a big reduction, generally speaking, in property values. You've got to look at the set of circumstances that generated that. There was an accumulation of circumstances that perpetrated that decline. It was about 20%, I think, as an average across the board. And given that we've had times in Australia in the last, say, 15 years when people have been forecasting declines of 40%, 50%, 60%. I remember one speaker came to Australia and trying to drum up publicity for a seminar tour. He said our land values were going to drop 90%. And media gave him lots of free publicity as a credible comment. It was just rubbish. It's never happened anywhere in the world that property values have fallen that much. Certainly never in Australia. But the US, about 20%, I think, is an average at that time. But they had incredibly lax lending standards. I mean, anybody could get a loan for anything in the US at that time. They had a massive oversupply of property. They had a recession and very high unemployment. So all those things were in a mix, created the circumstances where their property market were going to drop. In Australia, we don't have any of that. We have a shortage of property. We don't have a recession. We've got very low unemployment and falling. And we have, despite what some people say, we have very stringent lending criteria. I mean, anyone who says they're lax in this country obviously hasn't applied for a loan to buy real estate recently. The hoops you've got to jump through, and the time it takes, even someone like myself who's been around doing it for a long time and has got above average income and got a good portfolio and everything in your favour, you've still got to jump through millions of hoops and prove that you're not a vagrant to get a loan to do something in this country. So, we have circumstances that are least likely on the planet for our property prices to crash.
Yeah. Yeah, it's interesting, isn't it? Yeah. Well, on that note, Terry, I think that's a good place to leave. That's a good place to leave it. Thanks so much for joining me again.
It's okay. There's so much more to say, but probably people are going to get sick of this iconoclast.
Well, let's do another one soon. There's been a little while between drinks, so let's hook it up again soon, and we can kind of keep this going and tackle more myths about the property market. I think that'd be a really good way to keep this going. What do you think?
Yeah, it's so important to have these conversations and people to get a different perspective from the media one. But look, I think the most important message for people to take home is that you might be reading a lot of stuff about what's recently happened with property prices. It's irrelevant. What's important is the future, and you need to focus on areas that have got strong local economies, diverse economies, creating jobs, major infrastructure spend, affordability, low vacancies, high rental yields. Those conditions exist in many places around Australia, particularly regional Australia. And there's great opportunities there for people to buy well and build a portfolio that will serve them well in the future.
I couldn't agree more. Mate, great stuff as always. I love your insights. Thank you. Appreciate it. I'll see you on the next one.
You're welcome. Look forward to doing it again soon.